Hi, future homeowners. It's Leah Odom here with Homeowners Financial Group. I wanted to talk to you a little bit about mortgage insurance and what that does for you. If you remember from my earlier video about the different types of loans that are out there for you, you'll probably remember that mortgage insurance was a pretty distinguishing factor between the options we talked about. There's conventional. It comes with what's called PMI, private mortgage insurance. There's FHA. It comes with MIP, monthly insurance premium. And it also has what's called UFMIP, upfront mortgage insurance premium. There's VA, which has a funding fee, but no monthly premium. And then there's USDA, which has also a funding fee and a monthly premium, we'll call it. It's not really identified as mortgage insurance, but I think it serves the same purpose. So that's what we're going to focus on here today. Let's jump into talking about what mortgage insurance is. So, you may have heard people say you can't buy a house unless you've got 20% down. Well, that's not accurate because you can buy a house with less than 20% down. The beauty of having 20% down is that you don't have to have mortgage insurance. All right. So that would be a conventional loan, 20% down, no mortgage insurance required. The reason for that is that you've assumed a large part of the risk in the investment. The investor who is lending you the money feels confident that you're going to want to make payments so you don't lose your 20% down payment. You've got skin in the game. When you don't have enough skin in the game, that's when you have mortgage insurance as a requirement. And it doesn't protect you, it protects the lender. In the event that some tragedy happens and you can't make your payments and you've got to go into foreclosure, then they actually file an insurance claim against what would have been your down payment, essentially. And those amounts that you pay for the premiums, you pay for the premiums that protects them in the event you have to foreclose. So the amount of those premiums is determined by several criteria, just like your interest rate is in a lot of ways. So what we're going to look at is the difference between those premiums, conventional, FHA, VA, and USDA. Now, don't forget, all of this stuff is relative to many other factors. So we're really just digging in on what is mortgage insurance today. There's still a whole lot more questions you and your lender are going to need to solve for to figure out what's best for you. But this will at least give you some definitions and ideas when you're shopping on what you're going to see in the estimates that come from your lender. So let's start with conventional. Conventional loans with less than 20% down do have PMI, private mortgage insurance. Those policies are secured for you by the lender, all right? And we're going to shop for the best premiums and the best policy. Now, the reason conventional is the first one we're talking about is, number one, it's a little more complicated. And number two, the great thing about it is that when you get to an ownership position of 20% equity that's not mortgaged, meaning your home value, you've paid down enough that you are now an owner of 20% free and clear, no mortgage applied to it, you can actually submit a request to have mortgage insurance dropped. No refinance needed, nothing like that. You just submit the request, the lender drops the mortgage insurance. So that's a great feature of a conventional loan. And it's why it's my favorite, because we can't predict, goodness knows we can't predict what markets are going to do in the future. So the best way to give yourself the security of knowing, hey, at least when I get to my 20%, unencumbered investment, then I can request to drop the mortgage insurance premium. I've also found that if you're somebody who's going to go conventional, you traditionally have a higher credit rating. And so those mortgage insurance premiums are often less than they would be for an FHA loan. So that is why if we can go conventional, you'll see me say, hey, that's going to be a better loan for you when we compare everything. And I do compare everything. So we're going to talk about conventional a little further. What criteria goes into measuring how much your mortgage insurance premium is? Your down payment. Usually we measure it in increments of 5%. So you can do 5% down. You can do any percent down. Low is 3% down if you're a first-time home buyer. But mortgage insurance for that is going to be relative, meaning the more money you put down, the less the premium requirement is. Your credit score plays a big factor. I have found that if you're over a 720, you're good. Under 720, we're going to have to compare and really get in there and analyze it. So that's one factor as well. The other factor is the type of home that you're buying. For manufactured homes, it's a little bit riskier, so you're going to see higher premiums. Those are not all of the components that go into it, but the largest. So once you figure all of that up, then you're going to be able to determine what your monthly premiums are going to be for mortgage insurance. So that's conventional. Let's move to FHA. FHA, let's use the example of a $200,000 purchase. You can put down as little as 3.5%. So 3.5% on a $200,000 purchase is $7,000. But you'll notice if you look at an estimate for a $200,000 sale that's FHA, your loan amount's actually a little bit more than you might expect. That's because we're rolling in that upfront mortgage insurance premium I mentioned earlier. It is an exact 1.75% of the amount you're borrowing. So you're actually putting down you're putting down 3.5%, but you're borrowing a little bit more than that. Something to consider when you think about building equity and building wealth. You want to take that into consideration. So yeah, we've got the upfront mortgage insurance premium, but there's also a monthly premium. Now, people will tell you FHA mortgage insurance premiums don't go away. They do, but you have to put down more money to make that happen. You have to put down at least 10% down in order to make that go away. And if you're going to put down 10%, you're really not going to go with FHA unless it's a credit issue. And I mean, I put those quotes together all the time, but it's certainly, one of those things that we don't want to do unless we have to. So you want to assume that your mortgage insurance premium with FHA is probably not going to go away until you refinance. And remember, with conventional, it can go away and you don't have to refinance. So again, just comparing the two where mortgage insurance is concerned. The really great thing about FHA though is if you've got a 620 credit score, 680 credit score, or 740 credit score, you're gonna pay the same premiums. So you don't pay an elevated premium rate based on your credit score. I like that. I think that's great, and it makes it more straightforward in terms of what the premiums and the payment are gonna be. So then we've got our FHA loan pretty much knuckled down. The FHA loan does have a little bit lower interest rate. So what we have to do is compare and see one against the other and which one's going to be the right fit for you. VA, whole different game. So with VA, that's a loan that's available to, if you remember, our veterans, active duty, anybody that's served for more than 2 years. The way to find out if you've got eligibility and you think you're going to meet that criteria is to go to the VA benefit portal and look for your certificate of eligibility. Now, VA doesn't require mortgage insurance. That's because part of your benefit package is that they're going to guarantee the home loan for you. VA doesn't have to be the VA does not have to be the one that's actually writing your loan. A lender like myself can write your VA loan. However, what we're going to do is we're going to write it to VA's criteria because they're going to guarantee your loan if you foreclose, right? So it is still mortgage insurance. It's just paid for by the VA. It's a great benefit, and there is no monthly premium. There is, however, something called a funding fee. Now, the funding fee varies depending on when you're using the benefit. So if it's your first use, you are actually going to pay less anytime you use it because you can use your VA loan more than once. The second time, it's actually going to be, it goes from 2.1 to 3.3%, but it's financed in. But you remember what I said about the FHA loan and building wealth and how equity plays a part in that? Yeah, you're going to have less equity because you don't have the money down. So a lot of times I'll see veterans that are buying their third or fourth home. They have enough equity that maybe VA isn't right for them. The VA also usually has great interest rates. So again, we're back to the drawing board. Let's compare all the different loan types and see what's the best fit for you. Finally, we're going to talk about USDA. USDA comes with its own challenges, but it is not without an insurance sort of premium. So like FHA, it has an upfront fee. It's 1% and it's financed in. There is no down payment like VA. You're going to pay the monthly premium and the upfront premium just like you do with FHA. It's not as much. The downside, though, is that there are limits on how much you can earn. There's an income limit there. And also where you buy. You've got to be looking in rural areas that USDA actually identifies and targets. So with USDA, if you feel like that's going to be the right loan for you, we need to do some research up front to make sure you qualify income-wise and then see what's available to you from, what to shop for in the areas that you're interested in buying. So that is a breakdown on mortgage insurance as it spans those 4 loan types. I'm sure you have lots of other questions. Please be sure and drop them in the comments below and I'll get back to you. I'm happy to help with any questions you've got about lending here in South Carolina. Again, my name is Leah Odom with Homeowners Financial Group, and I hope you have a great day.